Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about cash flow, why cash is important, why the statement of cash flow is important, what FASB hopes will accomplish with the statement of cash flow, what the direct method and indirect method are, how we calculate the actual statement of cash flow as opposed to the simple version that we've done in the past. And then we started walking through an example of the 8 steps to creating an accurate actual statement of cash flow. We started by calculating the net change in cash to be our plug figure or check figure. We then went through and created our worksheets so that we had places to put and gather the cash information that we gathered in future steps. We went through step 3, which was gathering all of the information from specific transactions. These are transactions that as accounts we recognized during the period would change cash flows. So we kept track of them. And as we go through into our cash flow information, we could figure out the exact cash effects and the balance sheet effects associated with those accounts so that we would know what had already been accounted for as we move through the process. After finishing step 3 and doing the specific accounts, we then moved on to step 4, which was to look at our information in our income statement, specifically the accruals that we gathered that are crucial to creating earnings per share and net income that give us a good predictor of the future, and stripped out all the non-cash items. So what we have left, if we look at this worksheet for our operating section, is a bunch of accrual numbers: interest, cost of goods sold, wages, operating expenses, interest, income tax expense, etc., that may or may not be 100% cash. And we need to figure out if there is any difference between these accrual numbers and the cash numbers. And that's what step 5 is about. At least that's most of what step 5 is about. In addition to figuring out the changes between the expenses and revenues and the cash flows, we will also be looking for items that should have been included in these 2 worksheets, our investing and our financing activities. Hopefully, as part of our information gathering that got us ready for step number 3, we captured everything that should have been accounted for. But we're not sure if we did or not. So as we're going back through the balance sheet to account for these differences between accrual and cash flow from operations, we'll also look to see if there are some other cash flows that maybe we missed. And as a hint, in this particular problem, you can see there's a couple line items there that are still blank. That may or may not mean that we need another transaction, because when we create these worksheets, we just leave ourselves a bunch of room so that we can fill in as necessary. So now that we have done everything else, it's time that we got back to where we started. In a simplified statement of cash flows, all we do is look at the balance sheet changes and we use those numbers as guesses for what happened with cash flow. And you know, that gives us a decent approximation of the statement of cash flow. It's not as accurate or as good as what we've been doing, because if I just look at, say, PP&E, and I say that it's gone from 1 million to 2 million, great, I spent $1 million in cash. That doesn't account for the fact that maybe I sold some PP&E, and then I bought more, and then I exchanged some PP&E, and then I got a lease that helped me account for my PP&E, and none of that gets captured. All I did was put in, oh look, $1 million spent to get us from 1 million to 2 million, and I miss everything else. So does it approximate it? Yes. Is it accurate? Not quite. And that's what we've been trying to avoid. So now that we know we've accounted for all of the specific transactions, now we can just mop things up by looking through the balance sheet. And that's where we're headed right now. So I'm going to take a look at our balance sheet for this company. And you can see that I've set up my spreadsheet so that I've got the numbers right next to each other in our balance sheet versus our cash flow from operations worksheet. On the template that you have, you've got the balance sheet on the far left. If you need to use the hide column feature right up at the top, you can use that to get rid of some of the columns in the middle that are making it hard for you to see both the balance sheet numbers and the cash numbers in the worksheet. I'm going to bring those columns back. I actually need them for the calculations I'm going to do. So I'm going to run through step by step all the way through every line in the balance sheet. And hopefully it won't take us too long to do this, but I want to make sure that we talk about each one so that we can see how it works. Now, the first one is our actual cash account. And I'm not going to use that here. I used it in step 1. I'm going to use it again when I wrap up my statement of cash flows. It's not one of the adjustments, it's the check figure. So I'm going to leave it blank for now. The next account we have are these available for sale securities. And the question is, do available for sale securities have anything to do with cash flow from operations? And the answer is no, it doesn't. So it's not going to do anything to affect any of this conversion from accrual to cash flow information in our operating activities. But it might have an investing or financing cash flow effect that we haven't looked at yet. So to see if that's the case, I'm going to do a T account and walk through what's happened in this available for sale security account. So let me jump to PowerPoint where I can draw a T account. Securities available for sale. And from the balance sheet, I see that I had a beginning balance of $100,000 and an ending balance of $258,000. So we'll put those in. A beginning balance of $100,000 and an ending balance of $258,000. The next thing I want to do is look through my step 3 adjustments to see if I've done anything or accounted for any cash effects that affected this particular account. If so, then I don't need to account for them again. I've already taken care of it. If not, or if the effects that I find don't make it balance to that 258, then I'll know there's something else going on that I need to dig into. So let's go back to our step 3 calculations and see if we can find anything that we've already done that affects this available for sale security account. And hopefully it's rung a couple bells because we have done some things I remember that affected this account. So let's go see if we can find them. Let's see. All of the balance sheet effects are in this column. This is why I was so careful with this, is so it'd be easy to find later on. Let's see. Land building equipment, no. Common stock, no. Additional paid in capital, no. There's one. Increase to securities available for sale, 273. So let's go back. We had an increase of 273, and this was a purchase of stock. Let's see if there are any more. So I'll scroll down a little bit here. Land building equipment, accumulated depreciation, bonds, common stock, additional paid capital, no. Scroll down again. Investments in affiliated companies, no. Oh, there's one. Decrease in securities available for sale, 222,000. Looks like I sold some securities. Let's see if there's anything else. Common stock, retained earnings, bonds payable. We'll scroll down again. Treasury stock, other paid in capital, treasury stock, no. Pension obligation, OCI, land building equipment. No, that's the last one down there, that land building and equipment. Those are the only transactions I've accounted for where I've already taken care of the cash and said, here's what the balance sheet effect would be. So hopefully, if I take the 100,000 plus the 273 minus the 222, I get to the 258, because that means that I've already accounted for everything that's happened in the securities available for sale account, and I don't have to worry about there being maybe another hidden cash effect. Now, hopefully, as I said that, you actually did the calculation and you've realized that this doesn't balance. In order to balance, we need an extra 107,000. Now, the easiest explanation is we recorded this purchase of 273, but I guess there's another purchase out there. But wait a minute. Hopefully something else has jangled in your brain because of all the transactions and journal entries and things we've studied in intermediate accounting, and you said, wait, there's one other thing that affects available for sale securities. It's the market price adjustment. I have to do a market price adjustment every single year. That would also affect the balance in my securities available for sale account, because this company doesn't report a separate fair value adjustment account. They must have lumped the fair value adjustment in with the securities. And companies do that all the time. They keep two separate accounts, but they lump them together on the balance sheet. So I've got to figure out if the fair value adjustment was appropriately made, and if so, how much it was, because it might change this 107, and there might not be an extra cash flow effect. So let's go back to our balance sheet. And right down here, accumulated OCI, holding gains and losses for available for sale securities. So let's do that T account and see if that helps to account for that 107,000. So accumulated OCI, available for sale securities, started as a negative in the equity section. A negative in the equity section means it has the opposite balance of what equity accounts are supposed to have. So that's a debit. And it ended at 27,000 credit. It was a positive in equity. So now it's got a credit balance. So to get from 80 to 27, my fair value adjustment must have been for $107,000. That's what makes this account balance. So I credited other comprehensive income available for sale securities for 107, and I debited fair value adjustment, and that's the 100,000. So there is no additional cash effect here because everything's been accounted for. I've already, in step 3, I've already taken care of the purchase and the sale, and the 107 is part of a non-cash event. So I don't have to worry that there's an additional cash effect. It balances. So I'm going to make a note while I'm down here. I've already looked at this account, so there's no additional cash. That's the note I'm going to make. And let's see, I've also done that up here. No additional cash. I've taken care of it in my notes. The next line item was our accounts receivable, and we accounted for that. I'm going to mark it in purple as part of step 4. So I'm done with that one. The next is merchandise inventory. And I haven't done anything with merchandise inventory yet, but it would affect my cash flows. You see, the cost of goods sold number keeps track only of the goods that we sell. It doesn't keep track of the fact that we might have purchased additional pieces of inventory. So if I want to convert cost of goods sold to cash paid for inventory, I need to account for the fact that I may have bought extra inventory. So to do this adjustment, let's see, I went from 900,000 to 602. If inventory goes down, then cash goes up. Well, okay, cash didn't actually go up. What it means is I didn't buy all the inventory I sold this period. Some of it I had purchased back in year 5, and I've sold it now in year 6. So if I'm going to turn cost of goods sold into cash paid for inventory, I need to drop it by this almost $300,000 that I paid for last year. And since I didn't pay for it this year, I spent less cash this year. So let's see, I'm going to take the 900,000 minus the 602. There's my 298. I'm going to make it an adjustment over here, change in inventory, and I'm going to link it to this 298. And in this case, I'm going to go ahead and use green to track my inventory changes, just again, so that I can keep track of step 3 in red, step 4 in purple, and now step 5 in green, just in case there's a mistake. Let's take a look at one more and then we'll be done. That's prepaid expenses. Prepaid expenses were at 50,000. They're now at 4,000. We haven't done anything with prepaid expenses in step 3. So I need to look at that here. You can see we've got other operating expenses of $421,000, but I must not have paid for all of that because I must have used up this prepaid expense. So I paid for it in year 5. I use it in year 6. For accrual purposes, I showed that I've used up what I paid in year 5, but for cash purposes, I need to reduce that 421 because I didn't pay for it this year. So again, I'm going to take beginning minus ending, and I'm going to adjust change in prepaid expenses, $46,000. And when I net this out, my other operating expense is going to be 421. My cash outflow is going to be less than that because I didn't pay for it this year. I paid for some of it last year. Now, we took some time in this segment setting up step 5, so we didn't jump right into calculations. I think we need to stop here so that we can come back fresh and jump right into the other calculations for step 5. We don't want these segments to be too long. I know they get cumbersome when they are. So as much fun as I'm having, I'll let you have a break. When we come back, we'll continue on with step 5 and see if we can't get that section done and move on to steps 6 and 7 and 8 so we can wrap up this statement of cash flows. We'll see you then. Thanks.